So, have a new client that we're talking with the family on, and we're trying to figure out some creative problem solving. Now, the problem is, unfortunately, the client's spouse recently passed away. So, what we have to try to help figure out is how do we supplement some income that is now no longer accessible due to someone passing away? Now, this particular client spouse did a really good job planning for the future. And this client does have a good chunk of money set aside. But by the estimations of the family, they're going to need about $7,000 a month to help continue on for expenses for the foreseeable future, as that somebody is also living with the client here and needs some help and financial help as well. So once again, the reverse offers a very unique perspective to utilize the home equity now to help with living expenses or just general life, opposed to not even using it at all and maybe using the investable assets first. So there's a couple things we're going to look at here and some different strategies that I've spoken with about the family, and they're just trying to figure out what's the best option moving forward. So as you can kind of see here, this is a sample file I use. So, just to kind of play with some different numbers. And right now we're estimating the house to be about $700,000. Now, when I look it up online, it actually should probably be a little bit more based upon what I'm seeing, but we're going to run a little bit conservative on the numbers here. Current balance of the mortgage is 35,000. Frankly, the client has the money to pay off the house if they wanted a free and clear house. But the objective here is to try to increase monthly cash flow. And what ways can we do that? So the client really has a couple different options here. One, do a line of credit. And as this example here, based upon the current expected rate, we're looking at the line of credit being roughly about $237,000. Now, that client, with that $237,000 can do a variety of things with that money. They can pull out money per month as they need it. Typically you can make those requests either by fax, by mail, or you could do it from an online portal. Or they could take lump sums for different expenses as they pop up. There's really no limit to how they can pull money or which way they want to use it. There's only limit in the first year of how much they can access, but that's not normally a big deal because that would be a pretty significant amount of money. But if we take a look long term here on our simulator here, we can see even if the client decided they didn't need the money right now, or they have enough money for the next couple of years, maybe from some different accounts, you can see over here how the line of credit continues to increase to from 237 roughly up to 255, 273. And that's really the power of the line of credit. Is right now with the interest rate being figured at 6.63, the line of credit growth is a 0.5% above that, which is about 7.1. Now, the actual interest rate and the line of credit growth is much higher than this based upon what the 1-year treasury is, but we use the 10-year treasury to determine the expected rate. And all the expected rate tells us is how much equity you can access. The lower the expected rate, the more equity you can access, the higher, vice versa. So this client could take the option and just say, hey, we want to do the line of credit. We'll access the money as we need it and move on from there. Well, another strategy is if we were truly looking to help supplement some of the income. Now, granted, we can't do $7,000 a month from the reverse. It'll run out here pretty soon, frankly. And I mean, it's something that they could do. But what if we could help supplement at least partial of that $7,000 a month? And let's just say, what does $3,000 gets us? Because we can always look at the what we call a 10-year option, which would be essentially kind of like Social Security. It'll pay you X amount of dollars for the rest of the time you live in the home as your primary residence. And that number is about $1,700, which doesn't really do a whole lot for what we need here. But let's just say we can do $3,000 for as long as how long can we get that money? And by estimations, the client should be able to get that $3,000, or it kind of messed with the numbers a little bit, $3,010.28 for almost 9 years. So what that looks like over that time period is that they'll get that money every month. And roughly when you hit here, 9, you're going to see where it no longer increases the balance by, $3,000 a month roughly over that time period. And so what's important to take a look at is really what fits the client best. What is the scenario that best fits the client's needs? As I kind of spoke about with the family member on this, is there's really not a bad option here. Whether they do a reverse mortgage or not, they've got some great options they can work with. But the nice thing about the reverse mortgage, while it is debt, it does not affect the investable assets, and plus, or it helps supplement the investable assets. Maybe that's better said that way. And it doesn't require a monthly payment. So it's debt, but it's not adding any risk because the client's already going to pay taxes and insurance and HOA dues and live in the home. And so it's a very unique perspective and a unique way to utilize the asset now, opposed to waiting upon selling the property or when the client would pass away. So, here's just another example of many ones we see around here. The key, though, is just working with the family, talking with the client, and just making sure everyone's on the same page and have the same expectations. And really, the only reason this would be a bad idea for the client is if they moved in a short period of time. But if the client plans to be in the house for 3, 4, 5, 6 years or whatnot, then it makes perfect sense to utilize this as part of the retirement plan.